Thank you for watching this video. We would like to start off with a quick thank you to our annual sponsors. Our gold level sponsors, Geronimo Properties, Northmark, AEI Consultants, and EBI Consulting. Our silver level sponsors, St. James Real Estate Advisors and May Property Management. We would also like to mention our charitable partner for 2022, New View Communities, a CDC organization promoting affordable housing in central Massachusetts. To find out how you can become a sponsor of the New England CCIM chapter or to learn more about New View Communities, please feel free to visit our websites. There will be links in the description below. Greetings on behalf of the New England CCIM chapter. I'm Michael Chase, chapter president for 2022. Today is the final installment for 2022 in our CRE Expert Series, and we are very pleased to be joined by Wayne Spiegel. Wayne is a CCIM designee and the senior vice president with Colliers here in Boston. Wayne, thank you for accepting our invitation to speak with us today. Before we dive into today's conversation, let's start with a quick introduction. Not that you need one, but would you mind sharing a little bit about yourself?
Hi, everybody. I'm Wayne Spiegel. I got into the real estate business in January of 1983. And I probably eat, drink, and sleep real estate. I love it. I'm a commercial real estate broker, very, very strong in the industrial and R&D, but have done all aspects of the business. I have my own account of ownership, and I think I've touched every aspect.
Great, thank you. Well, you, again, in your position at Colliers, are, of course, very active. Colliers provides research on a number of market segments, both here regionally and on a national level. Our invitation today came as a result of one of your recent posts on LinkedIn. So tell us what you're seeing right now as we're kind of ending 2022 and heading into 2023.
Well, first, I must say that it's a very interesting time in the real estate business because there's a lot of things going on. And we've been in one of the hottest markets across all property classes, except maybe retail because of the pandemic. So it's been a very interesting time and things are changing daily. So it's for somebody like myself that likes to learn. There's no secret why I got involved with CCIM, because you have to learn a lot about real estate, the economics of real estate and the finances of real estate. And I enjoyed that very much. So, you know, the asset classes, there's no secret, the industrial market, which I started with in 1983, is very, very strong. I think I spoke at a CCIM regional meeting one time and said, people ask me what rents are in industrial. I said, you know, they're from 4 to 7, depending on how good or bad the market is. It really hasn't enjoyed the same appreciation as the residential and the retail market, which just continues to either mirror inflation or keep pace with it or exceed it a little bit. But industrial came into its own about 3 or 4 years ago. In fact, many new colleagues of mine jumped on the bandwagon and says, I want to be an industrial broker. Where maybe 5 years ago, people would say, industrial, you can make a lot of money with that because it's, you know, it's too stable, it doesn't increase. So, I mean, industrial, you know, it's still pretty strong, but it's the transactions are still down year over year, almost 20%. And, you know, multifamily, you know, year over year, it's only down 5%, but in the last month, it's down about 30%. Retail, year over year, 64%. Month over month, 36%. So retail is still in a funk, despite people coming back to restaurants and going shopping. The hotel market is the strongest, really. Year over year, it's up 28%, and month over month, it's up 60%. But you kind of have to remember that it's like how great the whole real estate market's done since the Great Recession, as it was called. Because it was so low, it had nowhere to go but up at that time. The most stable asset right now is industrial. One of the recent screamers of biotechnology is there's a chink in the armor. I'm reading that Cambridge, which you just couldn't get into, especially if you were a small biotech company, couldn't afford to build a whole brand new building. There's no space. Now I'm reading it's loosening up. There is more space, which puts a lot of pressure on the suburban speculative biotech space.
Mm.
The biotech market is not for the weak.
Right.
Because it's very expensive and the infrastructure is very expensive. And you have a good amount of good Fortune 500 companies, but you have a lot more of people trying to create things, make things. Before you even know if it's going to be any good, hundreds of millions of dollars have gone through people's hands, moving the risk. Certainly a low vacancy in the industrial markets, whether it be manufacturing, R&D, or distribution. So everybody was concentrating on the distribution markets because that's where all the action was, and big chunks of space were being taken. I mean, the Amazon factor is not there. Amazon started to say we want to buy the buildings instead of rent them, and then the next move is we want to sublease some space. And when the market rises and space gets scarce, in general, people take more than they currently need, so they have some built-in growth. That could become, when things slow down, what I call shadow space. It's not on the market, but it's really a vacancy because it's not being utilized and is a threat to the vacancy. The same thing is happening in office, and that's where it hurts. I took 100,000 square feet. I really only needed 70. Half my workforce is pushing for remote work. I have to do a hybrid model. And you know what? That extra 30,000 square foot space that I take, I got to make a decision. Do I want to sublease it, terminate it, get rid of it forever? Or do I want to sublease it and still control it because I may need it someday? So that particular part of the market only will show up in vacancy rates when it comes on the market. And it may come on as sublease space if they're not working with a developer on demand. And to say, let's get rid of this altogether, and then it hits the real vacancy market.
So we hear some people, raising funds or putting together cash to try to take advantage of, the blood on the street as you get into maybe a potential recession in the coming months or coming year. Do you see that as an opportunity?
I think it's coming. I don't think it's here. If you pick up the phone now and say, can you find me a rented building at an 8 to 10 cap, which, I mean, you would need almost an 8 cap to provide yourself positive leverage. I mean, if you're going to borrow at 6 and the constant's in the high 7s, you need to get 8. I tell clients that negative leverage, to some degree, is a viable strategy. Because if you see, let's say, for example, if you see below market rents, you would say, well, I can get at that. So I'm able to put together this deal on negative leverage. It's going to require more cash, though. And that's where, if somebody's putting together a vulture fund without calling it a vulture fund, they would be in a pretty good position to negotiate good terms and take advantage of this market. So far, blood in the street. There's probably people bleeding that don't even know it yet. If you've got a loan coming due and you've been paying 3-4%, you're going to pay 6 or 7% all day long at least. So, and for less money. So if you're over leveraged, you're going to have to right size that. I would say, definitely there will be opportunities. I mean, I heard the saying the other day, the sellers want yesterday's price and the buyers want tomorrow's price. It's tough to put together a transaction and create a win-win, or the satisfied with those two polarized opinions. And I mean, to bring back in this whole Federal Reserve interest rate, the bond market versus the Fed. So, the bond market has a yield curve that's inverted, not the one they teach you at business school. The risk. So, the 10-year rate is, maybe it's 3.56, 3.6 today, bumped up a little bit, but it came down in the last one. People are expecting interest rates to come down. I was hearing just 2 weeks ago, people saying, maybe the middle, end of first quarter next year, they'll start to come down. We're going to have a soft landing. If I hear that as a seller, I'm not selling, because I know I can get more when the rate comes down. If I'm a buyer, I'm not so sure I'm going to take a mortgage like that. I might take one from a regional bank, which is where all the action is really right now. But I'm not going to get myself locked up into a CMBS loan for 10 years because I'm stuck.
I've been hearing things such as maybe seller financing, seeing creative ways for people to get transactions done, or are you seeing more, like you said earlier, people just sellers are just kind of waiting to see what will happen?
Well, there are transactions happening. A lot of them are at the regional bank level, and they're happening at 60 to 65% loan to value. So if you're well-heeled and you have the cash, you can do the deals. The deals will have to make sense. The borrower will have to be a good person, somebody that pays their bills and has the ability to pay, still has the ability to pay their bills. And let's say that particular person doesn't have the amount of equity, or doesn't want to use that amount of equity, down to 60 to 65%, then the creativity begins. So let's say, you have half of that money, or you only have 20% of that money, and you want to bring somebody else's money into the deal. You could pay a priority return to that investor in the equity stack, and they're looking for, at least 8, maybe 9 on the coupon rate. And they're going to underwrite the deal to try to get into the high teens on an internal rate of return basis. Or you can go with the more of a less participating and more of a, I'm just going to lend you the money, but those people are going to charge you 15% for that equity. And that becomes kind of a struggle because of the low cap rates. Even on an interest only level, it's way higher. So I look at it like, yeah, you're going to have some creativity. But where the real creativity is when the blood starts to flow and everybody sees it, they're going to want to do a creative deal. And I mean, there is some seller financing going on. I want to sell my building. I want to sell it now. Rates are high. So I'll give them a 3-year loan or a 2-year loan. I'll charge 8 or 9%. And that's a pretty good return because I'm listening to everybody on TV telling me that they're going to start lowering rates in the middle of next year, which, by the way, is not true. Fed came out yesterday and he kind of let you know that's not going to happen next year. It's going to happen in 2024. And now, is he right? Or is the bond market right? Because the 10-year really didn't pop up to, 4%. I think the Fed's right. A lot of people think the bond market's right. But, I mean, inflation is 7%. Core inflation is 6%. People are celebrating because, it's not 7.1, it's not 6.2. The goal is to have long-term inflation at 2% over time. And even if they change that to 3% over time, that's half the floor rate. I mean, something drastic has to happen. And sure, goods are coming down, fuel's coming down, which will spike up again. So I don't see it anytime soon. And I think the Fed has no choice if they want to bring inflation down, especially their lofty goal. So we hear this thing called the terminal rate is where they're going to stop. What's the end game? And that rate's going to be there for a while. It's not okay. So the terminal rate a week ago, that's 4.8, 4 point, everybody's speculating. There was maybe a few people saying 5, but because the bond market wasn't going up, but they didn't see it. So they were, it's confirmation bias. So we all want the bond market to win. Nobody
Absolutely.
wants higher rates,
Yeah.
right? So,
Right.
but what happened after yesterday? Okay, now there's, I don't know, I think there was like the majority of the Federal Reserve folks were in the camp of 5+,
Yes. Yep.
right? And there were a couple of doves down there at high 4s. What are they telling me? Until we see a recession in the labor market, now, true, there's a little dent in the labor market, especially out on the West Coast. So far, it's more or less a white collar chink in the armor. The tradespeople and the blue collar, they're not taking less or getting laid off, still looking. So it's starting. Now here's the tricky part with all of this is there's a lag. And so people think this lag effect is going to happen sooner than later. I think those are the deniers. And then other people saying it's never going to happen. Those are the fears that they're wrong because it's going to happen. But it's a long overdue recession. Once people agree where the market is and it becomes less uncertain, they don't really want to use the word volatile, but a lot less moving uncertainty, then transactions will occur and people will figure it out.
So Wayne, is there anything that you're talking to your clients about today and kind of giving them one piece of advice as we're heading into 2023?
Yeah, it's hard. People ask me all the time, like, what would you do right now? And I think the safest thing to do is if the rents are market, and in your opinion, the next 3 to 5 years, not just this second, I would say, try to do a reasonable deal at a cap rate where it either just equals the constant or is slightly above a positive leverage. If the rents were extremely below market, you could even do some negative leverage because the rates are going to come down. If you had to ask me when, and I don't know any more than anybody else, but I think it's a very risky recommendation to say it's going to happen anytime before the beginning of 2025. The astute investors understand all the assumptions about the market, the rents, and this is not a time not to put money into your real estate if you're a long-term holder. This may be a time to do some improvements that make the property better than it was before. If you want to do something to try to prop up values in interest rising market, there's always something you can do. And I would tell people right now, don't get over leveraged.
Great advice. Always great advice.
What Mark is saying to everybody is, I'm going to recommend to you, which I think is good sound advice, is, make sure that you can refinance this.
Wayne, a lot of great insights. Thank you so much for taking the time and speaking with us today. One question we always ask at the end of our interviews, is there anything that the New England CCIM chapter can be doing for folks like yourself and firms like yours?
I think they do. I think they do a good job. I think, more is always better. CCIM rolls out courses not only the traditional week-long courses for the designation, but they roll out both for their applicants, their candidates, and a member like me used to take courses all the time. And it's very good. I mean, they focused on the economic fundamentals and the finances, and the instructors in depth on all kinds of developments across the entire property types, all the specialties. And in fact, they now have, which they didn't have when I joined up, a track for development. So it's for somebody that wants to be in development and wants to know, how the money works and how to be accurate, how to do all the research. It's good to take. You as our president have done a great job in, especially these YouTube interviews, which I watch.
Thank you.
Keeping people together and not letting us all forget we're CCIMs and can benefit from each other's assistance during a pandemic. I mean, it's not hard to get people together, but you're doing it. You're doing a good job. Thank you.
Thank you, Wayne. And thank you for taking the time to chat with us today. And thank you for taking the time to view this video. You can follow Wayne on LinkedIn and through the Colliers website. Links will be included in the description below. We will, of course, have more great speakers and content coming next year in 2023. So please like and subscribe and keep an eye on this channel. Feel free to follow us on LinkedIn and other social media platforms. And thank you for viewing.
Thank you, everybody.